Welcome to the Contractor Success Forum. Today we are taking a deep dive into working capital for contractors because working capital is the lifeblood of our business, baby. And we here at the Contractor Success Forum are here to discuss how to run a more profitable, successful, meaningful construction business. And who do we have with us? We have Stephen Brown, McDaniel Whitley Bonding and Insurance Agency, and we have Wade Carpenter, Carpenter and Company CPAs, and I'm Rob Williams with Irongate Entrepreneurial Support Systems.
Yeah.
In authoring the Pumpkin Plan for Contractors, which we are really stressing cash flow and all that.
Today we're stressing working capital.
Yes. Well, working capital, which is I think cash flow when I think of working capital, because you need working capital for cash flow. So, yeah,
Well, first of all, everybody needs to know, Wade, what is capital and how do you make it work?
Okay. Well, let's define what working capital is and why it makes a difference. Essentially, it's a measure that people like Stephen or a banker would use in evaluating a company, as well as you should probably think about evaluating your own internal company from this metric. But working capital is essentially a company's ability to meet their short-term obligation, pay their bills. It's the amount that a company has to pay their expenses. That's the simple definition.
Mm-hmm.
I feel so strongly about this that in Pumpkin Plan for Contractors, the book that I'm writing, for us as contractors, I mean, this working capital is everything, especially if we're bonding and things, because you got to get the bonds. And I've added that into my version. That's one of the differences of Pumpkin Plan for Contractors versus the other. Because if you're going to grow a colossal business, and if you look at Jim Collins, and he said the things that made a business go in the long term were the people that had those resources to, quote, get lucky. So when you get lucky by having the right capital available to take advantage of these things. So to me, this is so important. And let me add one more thing. The motivation for this, when we were in our coaching business, coaches of all industries all over the world were at this meeting with Vern Harnish. And Vern, well, first he said, oh yeah, the first thing you do is start with your people. And then somebody said, well, what about the cash? I thought we started with the working capital drill, which we call the power of one or cash flow story, but it's about working capital. He said, oh, well, of course we do that first. I just thought that was like given. So yeah, you do really got to know where you are in terms of your working capital, which you're hearing this word. And I bet we have a lot of guys that don't even know what we're talking about when we hear working capital. So what the heck does that even mean?
Well, yeah, let's get down on basic level to start. And I'm going to have to throw out a few definitions first. But the simple definition, the calculation is current assets minus current liabilities. And we'll get into what those terms mean in just a second. But, if you have more current assets than you have current liabilities, you have positive working capital. If you have more current liabilities than you have current assets, that means you have negative working capital. So,
Yeah.
if we can, let me just quickly kind of define those three things really quick. First of all, asset. What is an asset? Asset is something you own. It would be something like cash or accounts receivable, or if you have inventory. It also includes things like fixed assets, your desk and computers and machinery and equipment and vehicles. Now, we'll come back to not all of that is included in this calculation, but let's start with what's a liability. Well, simple definition of liability, stuff you owe. Assets are things you own, liabilities, things you owe. So things like accounts payable, bills you owe to your suppliers, your subs. You may have things like payroll tax liabilities. You may have credit cards. You may have notes to the bank, lines of credit, those liabilities that you owe. And the last definition I need to clarify is, what is the definition of current? Current means it is going to become cash or use cash within 12 months. So things like cash and accounts receivable and, inventory, but not things like your truck and your equipment. That stuff is not stuff that you're going to expect to convert within 12 months. The
I
liability
heard it
side,
Wade called liquid assets. What does that
yeah,
mean?
yeah. And we're going to get into that too, because
Okay.
I want to talk about what the difference between I mean, taking a deep dive on this one subject, I want to talk
Yeah.
about how a bonding company would look at it. I think Stephen can chime in on this versus a banker. And I think a lot of times a banker looks at things very differently as well. But
I I have a question for you on that because I think the way I learned about the current part, and I guess it was the way our bookkeepers did it when I was in my 20s and 30s, is we did it by what was current. I thought it meant in the calendar year, not 12 months, because that's the way I guess everybody did it. And I guess they probably just had a process back then that they would switch everything at the end of the year because they were only worried about the financials being right the last day of the year. So I always thought it was the current year, not 12 months. So will you clarify that? Is it 12 months or is it current year?
what it is 12 months. So
Yeah, we
if we
didn't do
gave,
our book that way. So that's interesting for me to
well,
have learned
if we
that.
needed to give Stephen a statement in the middle of the year,
Yeah.
you
I
know,
guess we just never did that. So
we should, and again, coming back to things like notes payable, a note payable, you may not have all of that due within 1 year. What that would be things like, the principal that is due within 1 year, not the
Mhm.
payments. And there's pros and cons and, things like that. But I see all the time where CPAs will kind of ignore that and they'll just leave it all long term. And then we
yeah.
go and give it to a banker or somebody like Steven, and then they start drilling into it and say, oh, well, this is really current, so we're going to have to throw this out, and it makes them not trust the numbers.
Yeah.
We don't trust the
Steven, I don't know if you
CPA
want
when
to
we
chime
have
in
to
on
do
that.
that.
That was the theme. I guess I keep referring back because I've been at a 3-day retreat with coaches on there, and we did have a lender talk to us, and then we had a buy sell thing. And boy, the theme of both of those is if your books are wrong when you bring this stuff, you better know it and be able to say it before they tell you. You know,
Yeah.
'cause it kills it. Because maybe you don't want to make these mid-year entries, and I understand that that's tough, especially if you've got an outside person that you hired to clean these things up. Understand these
Well,
things.
if you hired somebody to do this for you, it is
Yeah.
part of their job to
Yeah,
make
well,
that
Clean
make
it
that
the
up.
point is
adjustment.
they only hire them for 1 day a year, a lot of these
Well, that's
guys,
true, but
and then they don't
Well,
know, the contractor doesn't know, and so a big red flag goes off to these lenders, or if you're selling your company, that's even
yeah.
worse, but
well, yeah.
you won't know what you're talking about, you know?
This is why you hire someone like Wade, Rob. He
Yeah, yeah,
knows
he
he
did
knows
all
what the bonding company and the bankers want to see, but he also knows what needs to be represented for you to see. That's more important. This should be important to you. Working capital is everything. We talked about giving these old business terms sexy new names like, Ferrari flow or something,
yeah,
I
Mhm.
mean, sexying up a little bit, but capital that is working, capital cash, cash that is working for who? You, the contractor. Why do banks care? Why do bonding companies care? Because they're extending credit to you. So you do it for you. Sorry to get passionate, guys.
Hmm.
This is huge topic, Wade. Thank you.
Well, that's where
Working
you were.
capital.
I was hoping you would go with this because for a
I,
bank,
I've been just sitting here, just wound up, Rob. I mean,
okay,
yeah,
whipped into a frenzy. All right, real quick. A bonding company, a general rule of thumb. I'm going to look at your financial statements and I'm going to see if they're done correctly by a construction oriented CPA. Are they percentage completion financial statement? Do they have a work in process report? Are there over and under billings? That's number one. Number two, I look at the working capital. So I look at the current assets minus current liabilities. And Wade, you said we were going to talk about both those
yeah.
in
yeah,
more detail, but current assets being cash, anything that can be converted to cash is what the bonding companies look for.
Which
So,
would be inventory and work in progress mainly, probably, but
well, inventory doesn't count as cash.
yeah.
It's
Well,
what
that's
can
the point I want to get into in a minute
Yeah,
because
yeah, they might give you some credit
yeah,
for it, Rob, but it's, if
yeah,
you have a cash value, life insurance is considered cash. But anyway, say that you subtract the current assets from the current liabilities, and that statement shows there's $100,000 in it. Well, bonding company conservatively would give you what's called a 10% case, or you divide that by 10. So $100,000 of working capital would get you $1 million worth of bond. Okay,
right,
that's a very conservative look at working capital.
yeah. That was one of the two rule of thumbs I was hoping you'd throw out. Is essentially 10 times your working capital or 10 times your equity is one of those things that it's not. set in stone, and it depends on facts
No,
and
it's not.
circumstance.
It's there. If someone needs a bond and you see it's there and there's net positive net worth in the company and there's a good statement, then I'm off and running getting your bond.
Yeah,
Okay.
and so you guys listen to this because for a decade, I thought it was 10 times the amount of cash you had in the bank account because that's what my contractors buddies told me.
No.
Nobody official told me that, and I
No.
couldn't believe you guys bonded me because it was all these receivables that
Well, so if we can, the other rule of thumb I wanted to throw out is the working capital ratio, which is essentially your current assets divided by your current liabilities. And generally speaking, 1.4 to 1 is generally what I tell people is a healthy working capital ratio. So I wanted to kind of explain what that working capital ratio is and maybe talk about ways you can manipulate that one way or another and how that can be, twisted. But also, you know, I wanted to also kind of spend some time talking about how Stephen would look at working capital versus a banker would look at working capital.
Okay.
So, if that's okay, let me kind of jump into the working capital ratio real quick. Essentially, we got current assets divided by current liabilities. And just for easy math, let's say we had $200,000 of current assets, 100,000 of current liabilities. We have 100,000 of working capital. But if we divide 200,000 current assets by 100,000, that's 2-to-1 ratio, right? Now,
That's more than the 1.4 that you said was
right.
healthy.
Yeah. But let's just say we took $10,000 at the end of the year and paid down our payables by $10,000. So now current assets is a 190, current liabilities is 90. So if we do the working capital ratio, your working capital ratio actually jumps to 2.11 times. And I hope you see this can be manipulated, but I would recommend you talk to people like Steven. And a lot of times they want to see so much liquid assets, cash in the business at the end of the year. So we can kind of get into some of the details of that. But does that make sense, guys, how we can kind of manipulate that?
Yep.
yeah, it really does, and I'll talk about some things more specifically, but I want hopefully you'll hit them first, but I'm making some notes, like some of the inventories and then the types of loans.
Well, see, another trick I used during COVID and PPP when they were giving out these EIDL loans, these things were kind of a once in a lifetime thing, which if contractors realized what they could have done with it, and I had some contractors do it, is say we had that 200,000 and 100,000, but we got another $100,000 EIDL loan, 30 years to pay it back, 3.75% interest. Well, so we stick that extra $100,000 in the bank. So we're going to pump up in the example I gave you before, 300,000 of current assets, but our current liabilities are only going to show what's due in principal within 12 months. Well, that may be $1,000. So in that case, at 10 times the working capital ratio, you raise your bonding capacity by $1 million, assuming you
Nice.
had the equity to cover it.
I'm glad you said that that's what this lender was talking about, and he said he can do construction lending too, but he said the biggest thing, he said, "Use the right loans for the right things." So many people are using their lines of credit for these
Buy
permanent loans.
assets.
Yeah, to buy assets. He said, "Line these up to correct if you buy something with it," because, and the big thing he said is, "What is a line of credit for? Is it to buy a boat?" It's like, no, that's what people do. Definitely don't buy a boat. I thought that was pretty memorable with your line of credit that's gonna
What
depreciate.
about a Ferrari? Can you buy a
Yeah, you
Ferrari
buy a Ferrari, yeah.
with
But
your
buy
line of
your
credit?
equipment, get a long-term loan that's gonna be on there, that'll just clobber you. It's so easy to buy from your line of credit, and the line of credit, a lot of times, is just automatic because the owner may not even know. They just use the cash in their account to do it, then the line of credit goes up and down, and they don't have that, and boy, he was
Men-
just on that he sees it over and over and over again.
I'm,
Mention to your banker too that you're buying a Ferrari with your line of credit, and they go running to see what kind of collateral they've got.
I'm glad you brought that up, Rob, because I was kind of wanting to talk about some of the things that the bonding company would take in and out of the working capital. They basically will adjust their working capital. But,
Yeah.
Stephen, I'm going to ask you, I mean, if somebody had $100,000 line of credit and it was unused, would you take that into account for your bonding
Well,
capacity?
here's something interesting. No, the bonding companies don't put into account, but the small SBA bonding program gives you working capital credit for unused bank line of credit.
Right.
So, what a great way to help a small contractor. You might say it's because the SBA program is to help someone that's trying to get to the position that a standard bonding company will bond them. That's what they're there for.
Yeah.
But cash is king, working capital is cash. But think about from their perspective, a bank or a bonding company is saying, you have enough cash to get you through the year if you're losing money on this job. You
Yep.
seem to be cash flowing your projects. You seem to have a history of making consistent profits on your work. Yeah, we're all in. You
Yeah.
got positive working capital, you have positive network. We are all in.
I've
Yeah.
seen that
Well,
all
it's
the time. I mean, people are a lot of times they will kind of throw that in there, but there's also things they'll throw out. You mentioned the inventory
Yeah.
situation, and a lot of
Each
contractors,
bonding company does their own analysis.
right? A
And
lot,
sometimes as a bonding agent, we have to argue a little bit. Now, come on. They're an electrician and they have X amount of inventory that they're going to use on the next job. This
right?
is a job you want to bond and they don't have to buy any materials. They got an inventory. You got to give them some credit for that. And
Times
they
they throw
will.
it
You just
out.
got to fight a
Yeah.
little bit.
Yep. They throw it out, or maybe give them half credit or something for it. But
Mhm.
with COVID and supply chain issues, we had a lot of, say, electrical that you brought up. I mean, people would buy entire job up front because the prices and the availability of the stuff
Mhm.
was not there. So that was ensuring that they actually could do the job.
Yeah. And bonding companies don't care what your building's worth or your equipment's worth. It helps feather the nest when it's there, but they're looking at working capital.
well, that's great. Yeah, I get more and more ideas and stuff on here.
Well, let me throw a couple of more things out of there that a lot of people don't realize, and I know Stephen would say, what if you see a loan to the shareholder sitting in the current assets? What do you do with it, Stephen? Throw it out
Well,
the window, right?
that's thrown out so fast.
Yeah.
Yep,
I mean,
exactly.
I was talking to one of the ladies in the office, because I'm on this health kick thing, and I said, you know what I found out? If you put coconut oil on kale, it makes it easier to scrape it into the trash can.
Yeah.
It's the
Yeah.
same with loans to shareholders. It's like coconut oil kale. It's just right in that trash can.
Some of
Right.
the analogies you come up with, Stephen, I don't know.
Well,
Anyway, yeah, I agree, but there are other things like prepays, like, if you had a 3-month paid ahead on your workers' comp insurance when you start a policy,
hey,
whatever.
they accept that. Yeah.
Well, a lot of times I've seen them throw out prepays like prepaid rent, prepaid taxes,
Hmm.
things like that. But,
Yeah.
you
Because
know,
they don't understand. They don't understand
well, they
what it means.
don't. But, one of the things that we would do a lot of times is if, say, a contractor was going to be getting some money back on taxes, instead of like calling it prepaid, we would actually refund it, and they would have to turn around and pay it later. But we would put a income tax refund receivable that they would accept versus putting a prepaid taxes that they were going to throw out.
Yeah.
That's
Good
great, Wade.
idea.
But a lot
Yeah.
of these things that people don't realize, like retainage receivable, you
That's
know,
cash. You've earned it if you finish the job.
it is, but I see a lot of CPA firms even don't catch this. But what if you got a 3-year job and you got retainage on a job that's not going to complete for another couple of years?
Yeah, because it depends on each contractor and which one their contract is. Most of these guys aren't sophisticated enough to have the right contract, so they may not see that for years and
Yeah,
years.
but a lot of times the bonding company would pull it out, and honestly, a CPA should be pulling that out of the current assets.
Wade, what I would say to you is, see, you understand it from the most of the times when I'm dealing with a CPA is they don't get it to the level. So if they understood it, they could pull it out or they could do the right thing with it, but they don't even understand the process that the contractor's going through with that. They just see that so many of these smaller contractors may not even ever get their retainage,
Yeah.
because they don't have a program.
Well,
You
it's why
get it, so you know where to put it, but
it's
most
why Wade's the
get it.
best. That's why,
Well, I
you
wasn't
know,
trying to get you to blow smoke. but
Yeah,
Yeah,
right.
no, but I mean, no, I know you weren't. That's why we love doing it
Yeah,
because you get so embarrassed when we do it. But
yeah,
seriously,
yeah. Because
keep going, Wade. These are great points. I hope other construction CPAs are listening.
yeah, keep
well,
going.
I mean, as long as I've been dealing with these and dealing with bond agents over the years, I mean, there's a lot of things that can be done to pump up your working capital before the end of the year, as
Hmm.
well as thinking about where you are. So, what I would say, and we didn't really go as deep as I really wanted to in some of these things, but the calculations here, if you know how to plan for it, I say it all the time, but we take a three-prong approach. It's like, number one, obviously, nobody wants to pay you more taxes than they have to. But if you can also look at the what is it doing to your financial picture, as
Hmm.
well as what is it doing to your cash flow? That's the third prong that nobody even talks about.
Right.
If you don't take that into account and you stop billing or whatever, and you screw up your cash flow in, January, February, that may be the toughest time for you to survive that part if you're seasoned.
Hmm.
Yeah.
So
I,
I feel like I'm preaching at this point, but
No,
no,
you're not. It's
and
great stuff.
and it's interesting because you're so knowledgeable about it. I just got through some conversations again explaining about the construction industry, and a lot of these really advanced consultants and even bookkeepers, they don't really get what the work in progress is. They'll like use the term in our cash flow story inventory, but they don't mean that. But where we have to put it is our work in progress out on the job. Some people would interpret that as like
I
they can only think of inventory, but it's on the job and it's actually in the building. Until you invoice that, it's still an asset. It's not a receivable yet, and it kinda disappears from some balance sheets or
yeah,
it fences off and stuff, and that's really difficult, especially for the smaller contractors that go through here. And when I was saying inventory way, because I've actually been explaining to the people that don't get it as much, I'm using the word inventory sometimes to mean work in progress to explain it to the other people. But then we have the whole thing. I know, Stephen, you and I, when we were going through that course about what to count things in, is it delivered? Is that inventory earmarked for the job? And sometimes it's like, get it delivered, but sometimes you can put it on the ground. We used to do that. Sometimes we'd even invoice it when it was sitting on the trusses and wall panels. We'd invoice them sometimes when we had permission, but then it came a receivable when it was still on the ground on my thing. And then we had to mess with the balance sheet and stuff. That got really
Now,
complicated.
there's so many tricks to help you along your working capital and how it's presented by your accountant
I've
and how your
forgotten that some people, Wade, they do have inventory back in the warehouse, and I don't actually know the answer for that. Do you not count that? Because sometimes, that might be a year or two's worth of stuff, so it
yeah.
probably shouldn't be working capital, but I don't know what to do with
Well,
it.
yeah,
Most of my
but
guys don't have
you also
inventory.
think about the money that's tied up, and you hit the nail on the head, and I've talked about it before. That is the great missing piece of the contractor working capital story. The cash conversion cycle consists of receivables, the payables, and the inventory turns. And the inventory is exactly that. People don't realize how much money is really tied up in your work in progress because you got money tied up in the people and the materials, and it's sitting on your P&L. It's not sitting on your balance sheet. So
Yeah,
it's, I mean, we could stretch this conversation out
it's
quite a
been
bit.
expensed. That's how most of us did it. I did that in most of my things. It's been expensed unless you're capitalizing it somehow. And it just make when you don't have any revenue yet or receivable yet, so it makes your books look really bad when you don't
Mhm.
capitalize that
That's
inventory.
right.
And I guess it's okay if you're not reporting in turn, but God, look at that. If you're giving the books to a bank or if you're giving it to a bonding company, man, that can just be a make or break part right there to getting a loan. It's especially if you
Well,
got a lot going on and if you've got a slow receivable billing thing like a lot of contractors do. I was guilty. I'd go months sometime when we had plenty of cash without invoicing something. So my balance sheet looked horrible.
Mhm.
I know we're kind of long on this one, but that was a point I really was hoping to make this time because bankers do look at it very differently than bonding
Mhm.
companies, and bonding companies are actually a little more harsh about looking at it. But
Yeah.
there are things
And,
you can
and
slip by a banker. But
you know what was so funny? The banker's the one giving you the money. Maybe I shouldn't say this, but who knows the least about what they're looking at compared to the CPA, the bonding company, and the banker?
exactly,
I thought the bankers would know the most because they're sitting there with the cash and they have the most starch on their shirt.
Hmm.
So I thought that
Yeah.
meant that they knew the most, and it's just amazing how and they speak with authority, you know? So
Yeah.
Well, after
it's
we talked about, like, putting our
yeah,
our
that's right. That's
shirts, you had to put your
right. Jackets on.
sport coat on today, so I had to put mine on to keep up with you, but
Yeah,
Yeah.
well, I mean, you two guys look like movie stars. You look fantastic. Let me say that first and foremost. And second of all, let me say working capital is working capital. It's there to help you if you have unexpected cost. Do you have the money to pay the next year's worth of debts that you have, expenses that you have? And is there enough cash in your company to weather the storm when things get bad? That's important to bonding companies. Working capital is not Ferrari capital, it's there to work for your company.
Yeah, it's great, and again, I wanna say the first thing that we have been told to do in our scaling up coaching is get that cash flow story down to where you understand all these things in the cycle of what we would call our working capital. They use a little bit simpler terms because some of you might not understand that, but you gotta get that down. If you don't understand this, you can't even get in your thing. I know this book, I will maybe we'll have Ami on our show or something, The Growth Dilemma, but about all that. And you gotta get this down before you can have a game plan. And that was one of the points is you can't do your strategic planning unless you understand your cash picture and your capital, because why put a crazy growth rate when you can't fund it? You know,
exactly.
you don't have a way to do this. So I'm just huge on this right now because we've been
You're
planning.
wired, man.
I'm
You are
wired, baby.
wired.
You got me excited. This is I'm
Hey,
just
working
pumped.
capital is sexy stuff, Wade.
It's sexy, baby.
Not just a construction CPAs. It's sexy to your bonding agent, but most importantly, it needs to be sexy to you, right?
That's
It's your
right.
company.
Well, there's several things I wanted to dive in deeper, but I did want to offer if anybody was interested. I put together a little contractor guide to understanding working capital, and we have some of the examples in it that I mentioned today. So I hope that might help some people understand this a little better and why it's so important.
I didn't mean to not get you let you dive deeper. I got
Well,
but
that's
I
okay. No, I mean, I
had
think it was a
to dive.
great discussion, and we can put in the show notes how they can get that.
You know, to plug us a little bit on what we do, and Stephen may have some people is, Wade can run something on the Power of One in your cash flow and understanding it, not just for the bonding company, but what's even more important is for you to understand it. And that's one of the advantages of Stephen and them requiring that. It helps you understand your own business more. But
Mhm.
get us to run a cash flow story for you, or Power of One, something like this, and get the picture from you. Ask your own bookkeepers and accountants. But what I've found, Wade, is they might ask, and they're not going to be told that the guy doesn't know how to do it. But a lot of, especially people with bookkeepers, they just don't get that. They don't know who to go to advice. So ask the Contractor Success Forum for some help here, and maybe we can get some tools for you to work on this. Because to me, that's where everything starts. You can't plan unless you've got your cash picture and understanding of what's going to happen, especially right now with the government contracting. How many people have called you with a 300% growth rate right now, Wade? Something like this. And it's just like, buddy, you got to get this down. What do they say? More companies die of indigestion than of starvation, So this big business and understanding this
Mhm.
working capital is just huge. You can tell I'm all fired up about it. So, right. Well, we are here on the Contractor Success Forum. Thanks for listening. Get your resources. We have Wade Carpenter, Carpenter and Company CPAs. Give him a call, contact him, email or something to find out about this. Stephen Brown. It's amazing for a bonding and insurance agency that he knows all this stuff. That's very rare that he can know
Mhm.
these things. And then I am Rob Williams with writing your pumpkin plan for contractors. And if you need a cash flow story, you can tell I'm all fired up about it. So thanks a lot. Come back and see us on the Contractor Success Forum. Follow us on YouTube. Subscribe. Do us a favor and share it. And I'm getting more and more calls and contacts about it that said, oh, they've been listening to every one of our episodes and contact us. It's kind of fun to know that people are doing that. And get your MBA in construction here at the Contractor Success Forum. Do us a favor, follow it, like it, share it with other people. If you care about them, right, Stephen? If you love them, baby, Let them know about the
Yep.
Contractor Success Forum, because this is all free to listen to this stuff.
Hey, working capital, sexy stuff.
It is sexy
Sexy,
stuff.
sexy, sexy stuff, Wade.
All right. Everybody have a good day, and come
Okay.
back if we're not too odd and strange on the Contractor Success Forum, and see us again. Thanks.